Hey, income harvesters, welcome back to the Harvesting Income channel. Make your income and grow your income. Okay, today we're going to talk about an interesting exchange traded fund named IWMW, which is known as the iShares Russel 2000 Buy Right Exchange Traded Fund. And we're going to talk about the fund's performance in the last 1 year. It's a 1 year review, and we're going to see if the high yields are able to smoothen the ride and the volatility that you see in Russell 2000 index. The volatility and uncertainty is pretty high in this index because it's composed of a lot of mid cap and small cap stocks, and that's probably a volatile space. And let's see how the fund has performed and its pros and cons as well. Okay, before we start, just quick disclaimer: this is only for education purpose, understanding the different aspects of the fund, not investment recommendation. Okay, to get started, the iShares Russell 2000 Buy Right ETF is basically a covered call writing fund, and basically they hold the Russell 2000 Index Exchange Traded Fund, that is known as the IWM, which is also part of the iShares. And on the same ETF, the fund writes 1 month call options to generate income. So the fund is basically the IWMW, which writes call options on its holdings of IWM. So basically, the fund holds index exchange traded funds in certain quantities, and then they write 1 month call option on the same funds to generate income. And these call options are written out of money. So which means there is a scope for a little bit of upside. And I'll tell you the details, as we go ahead. So this is the basic strategy of the fund. And when I go further, like you can see the basic information or key metrics. The ticker symbol is IWMW. Price is about $38 change as of April 25. The fund was started last year, March 2024. So we just have about 1 year performance that we are trying to review. Um, and net assets 21 million roughly, and expense ratio is 0.39%. The fund is pretty small relatively compared to the other BlackRock funds, which are probably running into hundreds of millions of dollars or even billions of dollars sometimes. This is a relatively smaller fund in the iShares, stable, and expense ratio is pretty reasonable. So the fund looks pretty interesting. Like for anyone who is looking for income generation, this fund looks like an interesting option. Let's see how it has performed. That's the key that we are looking for. So without wasting much time, I'm going to show you the price performance, dividend performance, and also the total returns. I'm going to show you all three together as well, so you get a full transparent view that no other channel, no other expert has attempted to put it like, because this is going to give you the real picture. Okay, let's look at the price performance. Today, April 25, the current price is 38.48. 1 year ago, the price was 47.89 cents. So if you look at it, roughly it has fallen down by $10 or something, like it's 19.6% fall in the price. So negative 19.6% returns. So think about it, losing roughly 20% in 1 year. So that's been the performance of the fund. That is not at all good. Very disappointing. Very bad. Like this fund started in March 2024, and this is what you're seeing now. So thoroughly disappointing. However, one thing to keep in mind is when the index is falling, this fund is obviously going to fall as well. So let's now see the comparison with the index to see if the index really fell so much. So let me go to the next screen to give you the idea. But before that, we'll quickly look at the dividend yields. The dividend generated by the fund is pretty good. So every month the fund writes call options, and the option premiums are incomes which are distributed to the unit holders. So if you look at the dividends, like starting from May 2024, you go up to the recent one. The dividend distributions are all over the place. Like 78 cents is what it started with, then 51 cents, 63 cents, and December was a little exceptional, $1.41. Probably they paid the year-end amount, and sometimes it is in the 80 cents range, 90 cents range, sometimes 38 cents. Like it's all over the place. Like there's no specific range that you can target in terms of dividend. Dividend is highly variable. So that is something that you need to understand, that this fund is going to be a roller coaster ride. Like I mentioned in the first slide, it's going to be a roller coaster ride, not only in terms of the price appreciation or depreciation, but also in terms of the dividends, because of the high volatility. Sometimes volatility is pretty high, sometimes pretty low. So that's why you see this. And if you look at the trading 12 months dividends, it adds up to $8.94. And if you calculate the yield on that, like $8.94 by the $38 price, you get about 23% roughly, 23.2% to be precise. And that is pretty, very, very good compared to the index dividend yield, which is about 1.2%. IWM ETF provides about 1.2%. So dividend wise, it is pretty good. But on the capital appreciation side, you're losing 19%. So let's put the real story together. So basically, the fund lost some money overall, because in capital appreciation they lost 19%, and dividend they made a good amount of money. But we'll see the total returns in the next slide. But before that, I just wanted to give you a perspective comparing IWMW and Russell. Russell fell by 2.7%, whereas IWMW fell by 3.5%. Okay, when there is a flat or a falling markets, a covered call ETF is supposed to give you that cushion. So when index falls by a certain percentage, the covered call fund has to give you that buffer. See, for example, when the market performs well, the market goes up by 10%, index goes up by 10%. The covered call fund is not going to go by that level, because it has capped upside. Probably it may go up by 4%, 5%, depending on how the calls are written. But on the downside, the covered call fund has to give you that cushion, maybe lower amount of negative returns. But in this case, IWMW actually highly underperformed, even on the negative side. So that's the bad news. This is the performance with dividends reinvested. So the performance without dividend reinvested, when we look at that, it is fairly good, because the Russell fell by 2.6% and the fund actually fell by 2.3%. Slightly better, I would not say, maybe not that significant. It's almost like at the same level as the index, but it still seems to be okay here. But in the first case, you can see that the fund has underperformed the index, even in a falling market. So that's something which is concerning. Only time will tell how the fund will perform in the future years, over the medium term, long term, and so on. That still remains to be seen. That's one of the challenges with these covered call ETFs. It's not a simple um, dividend fund that you just invest in it and forget about it. You need to monitor the performance, and then probably sometimes you need to wait and watch. And when there is an underperformance and you see that it's going to be a temporary situation, you can use it as an investment opportunity. And this is only for the index covered call funds. And of course, this is not any kind of recommendations. This is something like an idea that I'm just telling you. Okay, moving forward, we have the total returns, all put in one page, like for your reference. So this is the value that I'm giving you. I'm putting everything in one, table, so that you can see the full picture. Okay, first let's look at the dividends. Dividends are excellent, and due to high volatility of the index in the recent months, recent weeks, you see this performance. And the other bad news is the price has gone down, depreciated by about 19.6%. The price erosion comes from the underlying index. Part of the bad news is justified. However, the ETF is not fully insulated from the downside. It's not providing the kind of protection the covered call fund has to provide. That has been the concern that many experts have raised, and also a lot of YouTubers and content creators have covered some of these, drawbacks. And if you look at some of the articles, they have covered this too. Okay, IWMW underperforms when Russell 2000 has a strong upside. So if I go back a little bit to those slides, see, even when the index is doing very well, like blue line is going up, the IWMW is pretty much underperforming. It's not giving you the positive ride on the upside, and on the negative side too, it's not giving you the cushion. So in both ways, you're not really benefiting. So sometimes it feels like you might as well invest in the index ETF rather than the covered call fund. So that's a big concern that, you know which is not being addressed. So 2% out of the money strategy that the fund is following should be giving you some kind of upside when the market is going up, but it's not seem to be working in that way. And also the price is not stable. Like, I thought this fund is going to be stable in terms of price, but it's not. Like, only time will tell if it's going to become stable in the future. We never know, but as of now it's not. And that is a concern for most income investors too, because income investors also look for price stability, because in the future you want to have some kind of, stability in the price, so that when you have some needs or when you want to sell and move on to other areas, you want that kind of value stability. Okay, pros and cons. Some of them we already discussed. Strong dividend yield and income, already discussed. And this fund provides a potential for appreciation due to the 2% out of money strategy. Yes, that is a pro, but in reality it's not working that well. So, that itself could be a con. And this serves as an alternative to mainstream indices, because compared to the S&P or Nasdaq, everybody is chasing that. You can also invest in small caps and mid caps and get that exposure. Or if you already have those blue chip companies in your portfolio, you want to get a mid cap or a small cap exposure, you want to get that spice, or you want to get that extra return, probably it's an alternative for you. And opportunity to monetize risk or volatility, it is just an extension of the same point. When you have a volatile index or volatile stocks, instead of going for single stocks, you can go for this one because it's a basket, and you can monetize volatility, because higher the volatility, higher is going to be the option premium, and higher the premium income for these funds. So that explains it all. So those are the pros you have for this fund, and there are some drawbacks too. And the first one is like, the fund significantly underperforms when Russell appreciates. It's not small underperformance, it's significant one. That's what is concerning. If it's a slight underperformance, like any other covered call ETF, it is not a concern. But here we see a big gap between the fund and the index performance. And total returns are very paltry, like hardly 3.5%. Barely covers the inflation. It's not going to help you grow your wealth or money. And there is a significant amount of uncertainty. This is something people have to keep in mind, that you when you invest in the mid cap or small cap universe, when there's an economic cycles or turns in the economic cycles, it could be favorable sometimes, it could be very unfavorable. Or if there is an interest rate cycle, there is high interest rates, then all these companies are going to get affected, and this index is going to get a beating. And also recently, in the due to the tariffs and economic changes, etc., a lot of uncertainties, all these mid cap companies and small cap companies are, very volatile, and some of them fell also, like, so that can actually pose a risk for investors. So the last point is an extension of that. So only a small portion can be allocated to this fund because of its small cap and volatile nature. So that's the, summary of the pros and cons. uh, let's move on to the next one. Okay, the last is the interesting bit. The three comparable funds, which I usually, talk about in most of my videos. uh, there are three of them which I found which are similar in terms of the index. However, the strategies can be different. The way they execute the call writing, the way they execute the strategies will be a little different. But the index is the same. So that's something to keep in mind. IWMI from NEOS. So this is the NEOS Russell 2000 High Index Income ETF. Recently, it managed to deliver 15% yield. Uh, Yield is only the dividend yield. We are not talking about the price here. So we are just looking at one side of the picture. So all these are not recommendation. This is just list of funds, random list of funds. So you have to do your own research. So that's something you need to keep in mind. So IWMI is a typical covered call strategy combined with purchased put options to capture the higher upside. Like so, basically, it's Neos also use the same covered call strategy. However, on top of the covered call strategy, they also purchased higher level puts at a higher strike price to capture the extra upside. So that's why they are able to give that extra upside or the extra yield. And in rising markets, when the markets are rising steadily, covered call funds underperform. But the MI, sorry, is going to capture that extra upside when there's a steady increase in the markets. So that's one positive of the fund. And it has other features. You can go to the website and check that. And second one is RYLD. RYLD is from the Russell, from the Global X funds, and yeah, they cover the similar index Russell 2000, and it's a typical covered call strategy. They write at the money covered calls, which means they write covered calls at the current market level roughly. So which means all the upside is given up, and it's mostly suitable for income generation or higher dividend yield and cash flow generation on a regular basis. So basically, the funds NAV or price is going to be either stable or probably decline a little bit, but you have a higher dividend yield, and the dividend yield can fluctuate depending on the volatility and various aspects of the market and how the calls are written, etc. But they rate at the money calls. So there is a kind of a trade-off, like you're getting higher yield but no upside. So for someone looking purely for income, then ROLD is a good option. And if you're looking at the other one, RDTE, the last one, it's a wonderful, fun, new concept, and it's called the zero day DTE, zero day to expiry options. I would caution people not to jump into this one. And this fund also provides weekly dividends, which is pretty interesting, and that attracts a lot of people. But I would caution you to first understand what they are investing in and what are the strategies and how it works, what is zero DTE and how it works. And then, if you are comfortable, you can take a small exposure and see how it works for you. But I would not recommend any of these to be the main part of your portfolio because as well 2000 by nature of it, like it's highly volatile and it covers the mid cap and small cap companies, and it's going to give you a roller coaster ride. So that's why I would say that you need to tread with caution with any of these funds. And last but not the least, we have come to the end of this presentation. And I would say IWMW is a wonderful option for someone looking for highly variable dividend yield. But if you're looking for something like a stable price performance, probably this fund is not for you. You can probably look at IWMI or other options. And I hope you liked the video, and I hope you found this useful. If you have any questions, any comments, any feedback, please drop them below, and have a great day. Happy investing.